Thank you for joining me. I'm Alexandra, and I want to talk about Discover. So, Discover is one of the better stocks that I've ever owned. I think I sold it at like 100% profit or something like that. Also, they pay a dividend, and obviously, credit card companies tend to be fairly stable, so reasonable, even without knowing the stats. So, what they do is credit cards. They are pretty well known for student loans as well, but that's a minor point of their business. Stock price is $99.61, which gives them a market cap of $30.6 billion. Revenue $11.1 billion, which is slightly down, which, somehow during the pandemic, people buy less on credit cards, which I don't really understand, but also 40 million people losing their jobs obviously kind of has an impact on everything. Earnings $1.1 billion, which is down significantly. As I assume with the forward PE, they're going to get back to about $3 billion next year, if they can hit that, obviously. Current PE is 28, which is not terrible, but slightly high. Dividend yield 1.77% with a payout ratio of 49%. So with the current bond yields, I think that for a dividend investor, that's kind of low, but obviously that's just a nice bonus on top of the assuming they can hit it, pretty nice forward PE. Total assets $112.9 billion, total liabilities $102 billion, which gives them a total stockholders' equity of $10.9 billion, which, as banks and financial institutions go, balance sheets always very balanced, so not going to harp on that too long, but stockholders' equity of a third of their market cap, obviously also not terrible, so I kind of like this balance sheet. Risk factors beyond global pandemics, I don't really know. I don't really expect people to get smarter about finances and never use credit cards beyond their means. So I think they'll be around for a long time. So for a growth investor, obviously credit card company is not quite the right companies to invest in. I really don't think that Discover is going to be the exception here. For a dividend investor, because of the stability of the company and the forward PE and the payout ratio, I think it's probably still a good buy, even though bond yields are up. I definitely would consider investing in this for the dividend alone, but the other factors play a big role as well. For a value investor, if they can hit the forward PE, it's going to be pretty nice. The balance sheet is pretty decent. The dividend is a nice bonus, and the company is very stable. So definitely worth a closer look for a value investor. That's it for me for today. If you like this video, make sure to subscribe and find me more videos every day before market open. I hope you have a successful day.